Well, for more on China's interest rate cut, the first time in more than 2 years, we're joined from Seattle by Don Gimbel. He's the Chief Investment Officer at Geneva Investment Management. Don, good to have you on the show. Thanks for joining us.
Glad to be here.
Don, China's central bank surprising the markets, cutting its benchmark one-year loan rate by 0.4% to 5.6%. Overall, is this the right move?
It's a great question, and the answer is maybe. I think that most of the information that is out in the United States and around the world, ex-China, leads one to believe that cutting rates in China is somehow going to be a magic wand for the rest of the world, and it isn't. This is really good news for state operating companies. It means that their interest rates are going to drop, and it's going to help the banks, and it's going to help the state operating companies. Whether it has a long-term effect on the whole economy remains to be seen.
All right. Well, what we do know is that the recent data has shown a slowdown and a persistent weakness from investment growth to factory production to retail sales, despite the more targeted stimulus measures. So can we deduce that these previous measures have not been working?
I think they're working. The question is, how well are they working? I mean, we know that the government has targeted 7.5% GDP growth, and that the narrow stimulus to individual industries, although it's produced some positives, hasn't generated enough growth to guarantee 7.5. It looks to me like the real number, if nothing else changes, is going to be someplace between 7 and 7.5, maybe 7.25, not dissimilar to what it was in the third quarter. Sorry, go ahead.
Don, the question is will this interest rate cut actually bring down funding costs in the real economy? Will it impact China's property market? Will it spur lending? Will it actually have an impact beyond the bigger companies and beyond the large sectors that have been benefiting from the targeted stimulus?
I would have said yes before I saw the non-performing loan numbers start to rise in China. And as a result, I think this cut is going to be targeted primarily for better quality companies and larger companies. And as a result, I believe it will not specifically affect new home sales or more retail sales, although it won't hurt.
Well, you know, bank officials were previously concerned that broadly easing the credit could make China's debt problems worse, and that it could put the market at a greater risk. And so it tried to channel specifically to sectors regarded as important, like small and rural businesses. So this is a wide sweeping reform. What's happened to that concern? Is that no longer relevant?
Well, I think it's relevant. They're trying, you know, this government is very tuned to helping the Chinese people and helping China. And I think what they're doing is they're trying something different than what they've been doing the last year and a half to see if that stimulates the economic growth, since inflation is still very much under control and there is capacity that needs to be filled.
Well, you know, other than this measure, People Bank of China also reducing the benchmark one-year deposit rate to 2.75% from 3%. And they're also giving banks more flexibility with managing their own interest rates. What's the desired effect from that move?
Well, I think maybe the concern that has been well publicized, that wealth management products, which aren't necessarily guaranteed by the banks, were getting to be too big a number, and that maybe by rebalancing lending and deposit rates is going to bring more money into the banks, which will allow them to make more loans, which can be better for the economy. I mean, it's still very early. I think it's going to take 1 to 2 quarters before we really see if this does anything really, really positive.
All right. Well, as we know, this has been implemented because there's been concern about China's growth rate slowing down. But Don, at 7%, China's growth rate is still more than double the U.S.'s and the envy of other economies. So is it really such a big deal if this happens, given the economy is transitioning?
Well, I agree with you. The fact of the matter is that we're seeing a large number of new people coming into the workforce every year, and we know that a growth rate of 7% or more is necessary to absorb the new people coming into the workforce. And that's what this is all about. We don't want to see the growth rate drop to a place where we start seeing unemployment rise, because that's very destabilizing in a country the size of China.
Okay, well, about 2 or 3 months is what you say is going to be needed to see if any of this has any effect. We're going to have to leave it there. Don Gimbel, thank you so much, Chief